So class, we're back at chapter 6, and the last part of the chapter has to do with the difference between what is called absorption costing and variable costing. And we'll use the way that we separated costs into fixed and variable costs to do these, and we'll also use this information as we go forward in some of the other chapters. So begin with absorption costing. And that simply means that all manufacturing related costs, either fixed or variable, are absorbed into the cost of production. Okay, just like you saw in the value chain, all manufacturing costs are in production costs. So that's direct material, direct labor, manufacturing overhead. They're all treated as production costs. And that's kind of what we've been doing all along. And we've done it because it is GAAP. And also that's how you report it on the IRS. So absorption costing is nothing new. This is what we've been doing all along. However, variable costing is what you use internally by management. It gives you a much more accurate information to determine what the cost of products are. And in this case, you only are going to look at the variable manufacturing costs being treated as product costs. And again, this is not GAAP. You can't use it for your financial statements or the IRS, but for internal management purposes, variable costing is preferred over absorption costing. And it leads to better decisions because it will show the incremental cost of manufacturing each unit, and the operating income will not be affected by changes in inventory levels. So students sometimes have difficulty with this concept of absorption costing versus variable costing, but let me just tell you up front, really the only difference is it has to do with inventory levels. And are those costs of doing production, are they trapped in the inventory, or are they completely included in the operating income? So you would typically get this type of information where here are all your variable costs. So notice what we learned the first part of chapter 6, separating the variable costs, the fixed costs, and then the mixed costs into the fixed and variable components. And then we have our fixed costs. And in this particular instance, we produced 40,000 units and we sold 40,000 units. Okay, so variable costs are given in the cost per unit, fixed costs in the total cost, because as we know, these remain constant and these remain constant by definition. All right, so let me just go back here real fast. And let me just say the big difference, everything that you see that is going to be the difference between these two methods of costing will come down to this one factor, and that is what is the fixed manufacturing overhead per unit, okay? And how do you get that calculation? Well, in this case, it's $1 million worth of fixed manufacturing overhead divided by 40,000 units. And this is where the $25 per unit for fixed manufacturing overhead is calculated. And this is important because everything is going to be based on this one calculation. And students get very confused with all of the information they have to put into these two income statements, but it's really this number right here that makes a difference. And you can see it here in this little, this would be what is the total cost per unit to manufacture, or the production cost. Absorption costing includes the $25. Variable costing does not include the $25. So when you ask what was the cost per unit, absorption costing is 75, variable costing is 50. Now, let's assume then we produce an extra 5,000 units. That means that variable costing is going to show $250,000 worth of costs Absorption costing is going to show $375,000 worth of cost. Well, this is not really very accurate because the fixed cost is not changing. Okay, so that's why you have this problem. Variable costing is much more accurate, and that's why it's used for internal decision making. If you look at the operating expenses for under the period cost, absorption costing keeps with our traditional way of doing it, where these are all period costs, but variable costing is going to include that $1 million of fixed manufacturing overhead in their period costs. Now, another word for absorption costing is traditional, or another word for an absorption income statement is a traditional income statement. Okay, it means exactly the same thing. And here you go, sales revenue minus the cost of goods sold. We've seen this many times, gives you your gross profit, minus your operating expenses gives you your operating income. That would be a traditional income statement using absorption costing. A contribution margin income statement is the same thing as a variable, or I should say it uses a variable costing method. So you can say a variable income statement or a contribution margin income statement. And this is the beginning of what we're going to use throughout the rest of the semester. And it all is based around this idea of a contribution margin being the key unit that we want to understand. And we'll get a lot more into this in chapter 8 or 7 and the rest of the chapters. So again, sales, and now we're just going to subtract out the variable cost. So it's sales minus variable cost gives you this contribution margin. And what does that mean? It's the amount that contributes to the fixed costs and the rest contributes to the operating income. Minus the fixed costs gives your operating income. Now, it was the same for variable costing and for traditional costing because we sold 40,000 and we produced 40,000. Okay, so that's really the key here is when you buy and sell the same amount, the operating income will be the same no matter which one you use. However, that doesn't happen most of the time. Now, one other thing to mention up front, service and merchandising companies, since they don't have production costs, it's always going to come out the same no matter what. So you just use the traditional way of calculating the operating income, or you can use the contribution margin if you're using it to do different calculations or predictions or forecasts. All right, now how do you reconcile when the inventory that is produced is different than the inventory that's sold? And it's quite simple. You can do an entire income statement for both traditional and variable, but really it just comes down to what's the difference in the units produced and the units that are sold times what was that fixed manufacturing overhead per unit. And remember that calculation we did, it was $25 per unit. So if you produce more than you sell, then you multiply the difference times the fixed manufacturing per unit, and this will tell you that absorption costing is going to give you a greater operating income, or another way of putting that is your operating income will be lower under variable costing than absorption costing. So when you produce more than you sell, absorption costing has a greater income statement and variable costing has a lower income statement, or operating income would be a more accurate term. By how much? The difference in the number of units. Now, if you sell more than you produce, now your variable costing will be greater than your absorption costing. So it can go either way, but that's really the crux of everything that this last part of the chapter has to do with. So when you reconcile this, you notice this is your absorption costing, so it's called the traditional income statement. Notice our operating income is $390,000. This is the variable costing system. Contribution margin income statement gives us operating income of $140,000. Notice the difference between the two is $250,000, which we easily could have calculated by taking the difference between the number produced and the number that were sold. Okay, class, that's it for Chapter 6. Good luck, and I'll see you when we get to Chapter 7.